Hi, Tim Bigham for Delta Derivatives, Option Hedges and Edges. Taking a look at a market that finally needed some downside hedging. We saw yesterday the biggest sell-off in over 2 years as all three major indices down well over 3% here. And we saw the VIX, which had been kind of stuck in that mid kind of teen range, shoot up well past 25, highest level in the past year. So I like the combination here to be selling out of the money puts or put spreads depending on the price of the stock. I can get further out of the money for the same net credit here by a large margin. So those names we were kind of cautious on before, the Microsofts, the Apples, Google, Amazon's, MAGA stocks, really were the ones that got hit hardest as the momentum broke here. That leverage had to be turned lower. So on Apple, I like going out to March. So on the 275, 270 put spread, getting almost 70 cents net credit. So kind of like that return on risk gives me about a 25-point downside cushion from here. Same thing with Microsoft, targeting that kind of 165 level on Microsoft, and Amazon back to the 2000 level, believe it or not. What a ride this has had. So you can actually go out, sell the 1900, 1890, get the same kind of risk return. Like to position one standard deviation out. Market tends to be leptokurtic, which means it either sits or moves big. We certainly saw both of those over the past week. So the in-between area is actually overpaid for how much it occurs. I like to position there. Otherwise, I think position size smaller here. Certainly this may not be done. Coronavirus fears can certainly erupt at any time here. And given the valuations are finally looking a little bit more attractive, and with bonds at multi-year or historic lows, depending on where you're on the curve, I think stocks comparatively on another sell-off will look like a buy. So until next time, as always, here's a good trading. Take care.